Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, May 4th, 2026. First of all, apologies for missing last week. Had a virus, missed a couple of days of work. We're back at it, so we'll catch up on just last week's activities. So if we look at the economic data released last week, fairly decent. The things that were important, housing index, we don't normally cover this, but certainly with affordability being certainly a big political hot button and certainly a focus of the administration. The house price index month over month for February was released on Tuesday. The expectation was it was going to be up 0.2 of a basis point, or 0.2% up over month, and it ended up being flat, so positive. And we had durable goods on Wednesday. Durable goods order month over month for March. The expectation was an increase of 0.5%, came in better, 0.8%. Also on Wednesday, the Federal Open Market Committee, was convened on Tuesday. Wednesday, they had their rate decision, and as we had profiled a couple weeks ago, there was virtually no chance of any change, and that's exactly what we got. No rate change at all after Wednesday. Then on Thursday, some big economic data hit at that point. GDP growth in the first quarter. We very often, almost every week here, we show you what the Atlanta Federal Reserve believes economic activity is tracking towards in any given quarter. During the first quarter of this year, the Atlanta Federal Reserve thought we started off exceptionally hot. They moved their estimate up from low 2% to 3.4% at its peak, but then started pulling it back. So they ended up, their last best guess was a 1.3% GDP growth in the first quarter. Turns out it was 2.0. So stronger than expected, which is both good and bad. So certainly we want the economic growth. What we don't want is any potential price inflation as a result. So also on the same day, we did get the PCE, personal consumption expenditure, the Fed's preferred version of inflation. And for the month of March, that was up 0.3% month over month as expected. So no push there. So that was all good. Personal spending also reported it was hot, strong, but as expected. So for the month of March, up almost 1% month over month, 0.9%. Personal income, though, did surprise to the upside. Expectation was 0.3% month over month growth, came in 0.6%. And the number that really kind of jumps off the charts, initial jobless claims, we've talked about it many times over the last couple of months, just seems to get better and better, surprisingly. We really thought we were going to see a bout of unemployment claims, initial claims. Hasn't happened. In fact, I went the other way. For the week of April 25th, the number came in at 189,000. That's the lowest I can remember. Certainly, I would say since 2020. And the expectation had been 215,000. Lastly, we did have the ISM manufacturing number, a little weaker than expected for April. It was expected to be 53.2, came in at 52.7. So with all the news last week, one thing that is occurring, certainly investors' expectation of inflation has been increasing. We've noted since the Iran war started that it was impressive that while oil had moved up from $70 a barrel to over $110 a barrel, that the expectation for future inflation in the U.S. didn't move that much, but it is starting to. So prior to the Iran war, we were at roughly 2.3% expectation over the next 10 years inflation rate. It's now moved up. It seems to move up a little bit every week. Last week moved up kind of significant, 6 basis points to 2.48%. GDP estimate for here, the second quarter, which started April 1st, the Atlanta Federal Reserve believes we're going to have another strong quarter, even stronger than last quarter. 3.5% is their point estimate. So as a result, in terms of the Fed futures market expectation of Fed rate cuts or hikes, we do have a June Fed meeting. The expectation is no change, 5% probability of a cut, probably not happening. By the end of the year, this really shows how investors are very indecisive and are very split on how they think about interest rates between now and the end of the year. 77% probability built into the futures market of no change between now and December 31st. Only 8% probabilities built in of one cut, and then 14% probability of one rate hike. That is very tight, and I'd say remarkable. Last thing about last week, we'll go through the equity numbers, returns for the week, and they're positive. The reason why, even with the negative news, gas prices, potential inflation shock, is that corporate earnings have been really, really good. So end of the day on Friday, 63% of S&P 500 companies had reported first quarter earnings, and 84% beat estimates. That's above the 5-year average of 78%, above the 10-year average of 76%. But by far the most impressive of everything we talked about today, the magnitude of the beat for those companies, 20.7%, just off the charts good. So if you're looking for one reason why markets that are all-time high, despite all the uncertainty, war, everything else, this is the answer. So taking a look at the returns last week, we'll start with the U.S. S&P 500 up 0.9%. Now, I personally would have guessed Mag 7 would have led it because their corporate earnings were fantastic, really led corporate earnings, 3 of the 7 that reported. However, that wasn't the case. So S&P 500 up 0.92%, Mag 7 collectively equal weighted up 0.6%. NASDAQ did lead the way last week, though, up 1.1%. We take a look at a year to date, S&P 500 again up 6.02 for the year, NASDAQ up better than that, 8.06, but the real winner so far this year, small cap, which is good for our portfolios. Russell 2000 year to date through Friday up 13.7%. Last week, mixed picture in terms of international returns. Developed markets ex-US up about 1%. Emerging markets, however, down 5.52%. On a year-to-date basis now, the MSCI World ex-US, developed market ex-US, up nearly the same as S&P. Again, S&P up 6.02%. The developed markets ex-US up 6.7%, but emerging markets still has a decided lead, up 14.61 on a year-to-date basis. Now, talked about inflation, some of the issues with that. Last week, it definitely hit the bond market. We had positive equity returns, but the bond market got hit. The 2-year yield was up 10 basis points last week, the 10-year up 7. So the Bloomberg U.S. Aggregate Bond Index was down about 0.4% last week. Now, let's take a look at the economic activity to be reported this week. We'll just skip some of the things that aren't that impactful. But tomorrow on Tuesday, we'll get the JOLTS job opening for the month of February. That came in at 6.88 million. The expectation is it's going to be slightly lower than that. Also tomorrow, we get ISM services, their PMI. The consensus is 53.8%. For February, that came in at 54.0. Thursday, this will be interesting. We keep talking about jobless claims continuing to be lower than expected. Well, now consensus has come. I think this is the lowest I've seen on this. The consensus estimate is 199,000 new claims for last week, and prior week, as mentioned last week, 189,000. Friday will be a big day, non-farm payroll. This is a big number for the month of March. Surprise upside, 178,000. It followed a very weak February. So March beat to the upside, 178,000. Expectation for April, 73,000. Unemployment rate is expected to be flat in April, 4.3%, same as the month before. Average hourly earnings, however, that's expected to increase slightly. So for the month of March, that was up 0.2%. For the month of April, this is expected to be up positive 0.3%. So that's it for our weekly economic update. We thank you very much for your attendance. I look forward to seeing you next week. Thank you.